Let's do it.
Okay. Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're back with you today for our weekly wrap-up. Graham, tell us what happened in the market last week.
Yeah, thank you, Stacy.
Sure.
We saw a pretty good rally last week. I think we ended the week up. We looked at the Federal Open Market Committee. The Chairman Powell continued to throw out hawkish comments that maybe they just haven't quite done enough. But that's not really that surprising. I think they really want to see the whites of the eyes of inflation before they're going to show their cards. And I think that's logical. They don't want the market getting ahead. They don't want the consumer getting ahead and trying to price too much in. They're trying to get inflation down, right, to this really low mandate. So we saw the Nasdaq up about 2.4%. The S&P rose just over 1%. But the one side of the market that's continuing to struggle from an indices standpoint was the Russell 2000 small cap. That was down 3%. So overall, we saw the market pretty split between the S&P sectors in terms of performance-wise, but it was still led by technology. Surprise, surprise, that was up 4.5%. And we saw energy slide, which we've been seeing lately, down about 3.8%. Maybe seeing some build in supply, maybe not seeing enough demand or concern with demand with some overseas market like China. So if we look at some other economic news, we look at the U.S. consumer sentiment fell to about a 6-month low in November. Inflation expectations jumped up about 4.4% from 4.2%. And the interesting thing is, I think this is a precursor here to maybe some lower gross domestic product, maybe some lower inflation, is we saw the consumer credit rising in September. We saw the credit card balances jump up 15% year over year. Maybe they're burning through this cash. Now they're going to have to go out and get loans. Now, those are negatives. I get it. But remember, right now, we don't want too bad of negatives, but we want to see some weakness. We want to see some negatives that could bring down inflation, GDP numbers, as long as they don't collapse them. So maybe the Fed just doesn't have to do as much or any more, or stay with rates higher for longer. And I think that's what the market would like to see. But internationally, let's go overseas. We look at the Bank of Australia. They were really the only developed world central bank that raised interest rates. If we look at China, still some surplus shrinkage in October, challenging the growth prospects over there. And we still saw Europe, in terms of Germany and Europe, struggling a good bit. And I think the UK basically right on the fence here in terms of shrinking Q3 numbers. I think there was 0. So they didn't have any real growth for that last quarter.
Wow. Okay, well, you know, those hawkish comments from Federal Powell, how did those affect our market?
Well, I think it's concerning, right, to the investor who's looking at corporate earnings, or they're looking at their own personal balance sheets. You know, they're wondering, how long do rates have to stay high? If you want to go out and buy a house, listen, I don't have to tell you, that's a lot higher than it was a year ago, right? At almost 8%. So that's putting the real pressure on the consumer that's still dealing with some supply chain and inflation issues in terms of some other goods and services they use. So they would love to know that the Fed is pausing and starting to lower rates, which would help. But I think it's still a little bit too early because, as I mentioned before, the Fed's not going to show the cards yet. They want to see the whites of the eyes of inflation really coming down and permanently, at least in their mindset, coming down.
Okay, well, what do you suggest an investor do?
Yeah. I think overall, you got to stay the course, right? If you've done your homework at the beginning, you're working with someone, you're doing it yourself, however it works best for you, and you've done your plan, you're thinking longer term, you got your short-term bucket taken care of with some great money market rates and CD rates over 5%. You know what? Make some adjustments around the edges if you have to, but don't make an all-out shift. You know, a fundamental shift without something fundamentally happening in your life, you know, usually that's not the best move for a consumer to make.
Okay.
Yep.
Thank you so much, Graham. And thank you to our viewers for joining us today. We hope you have a great rest of your week and a very happy holiday coming up next week. And we will look forward to connecting back up with you on the next weekly wrap up. Take care.
Take care.